All right, today I'm going to go through an example on an investment advantage, and it's what advantages you have as an individual investor, and I have timing examples. Ultimately, when you're an individual, you know exactly when and how you're going to use that money, so the time, you can map your investments perfectly to your timing. And I'm going to give an example where you're holding an overvalued stock, and you have yourself just looking at the investment and say, maybe, you know what, this is an overvalued stock. I think I'm going to sell some of it because I want to invest in something different, or I want to use the money one way or another. I can make that choice. Now, what will happen, and if we're looking at like what do we have as an advantage over, say, maybe an ETF manager, a mutual fund manager, is that that same manager, if they're holding that overvalued stock, well, why would they just keep holding it? Why wouldn't they sell some of it if that manager knows it's way overvalued? So one reason why is that they're being measured against a benchmark. So say we're being measured against this benchmark. I now have the pressure of, I've already taken, say, a 100% return on the stock or the group of stocks. And I was like, you know, I would really like to take some off, but there's a chance that that might go to 120%. And if I know that I take some of the risk off, my 100% might only go up to 110%. And even if it's this a one period of time, we're looking at one quarter that a person's looking or evaluating how good is my stock doing. It's like, well, it was up to 120 versus only 110. I don't want to hold my money with you anymore. So they have what's called tracking error. They have to keep as close to the market as they can, because they know if they're too far off one way or another, people start to get a little nervous. And a lot of times it can be just the human reactions, like, well, I got 100%. You forget that you made 100%, and then you only see like, well, it went up to 120 and you only went to 110. What happened? Well, in reality is that you wanted to lock in that 100% gain. The example of you're sitting in a position where you want to take a gain, and the mutual fund manager says, I can't take that gain because I need to stick to the benchmark. Even though the same mutual fund manager, say you lose 30%, but the index that they're being benchmarked loses 32%, technically that mutual fund manager outperformed, because that's all they're doing is they're trying to beat a benchmark. And whether the benchmark goes up or what benchmark goes down, they need to keep close to that benchmark. And not having to be worried about a benchmark, you don't have to think of things in such short-term periods of time. You can think of them on a longer, much longer period of time, and not have to take those sacrifices of not being able to take gains when it's most appropriate. And also knowing when exactly that timing and the money you're going to need, and how you're going to want to use the money, and what's the realistic expected rate of return. So hopefully this helps out a little bit. This one's kind of hard for me to explain, but it certainly is a big advantage as an individual, and you don't have to always be looking so closely at, well, do I need to follow the benchmark? Do I need to beat the benchmark at all times?